Hey traders, Stephen Kowitzel here with TradersPlan.com. It's Thursday, September 20th. I'm going to go over a lot today. Going to cover the market. Big moves in the dollar and big moves in interest rates, which is we're going to see how that affects and watch to see how it affects a sector rotation. So I want to start right now with the Nasdaq. So let's get right into it. You know, it really has been a pretty easy chart. Last week I talked about how it feels very 2013-ish, and 2013 was just, a year where there was just a straight line up. Now we did have a nasty correction from the end of January to April, but it found its footing, and what I mean by that is, and then it just went on major runs where it wasn't really in rally mode where it would find support at the 20-day moving average. It continued to find support around the 50-day moving average, which it continues to do so, and then just grinded its way higher for a 35, I think, approximately percent gain for the year. So I think it's very important to understand that we're in a major bull market. Bull markets can last longer than expected. Bear markets can last longer than expected. So it's very important to, I think, one, not to get complacent and get too excited and buy things just to buy, but, to really have that strategy plan in place, for, more so your short-term investments. I think your long-term investments, you just let it run. It's going to do what it's going to do, but you're more short-term, have a plan. Like, for example, if you bought, let's just say a leveraged ETF on the pullback back to the Nasdaq, maybe you say, okay, if it doesn't find support the 50-day moving average, it breaks, we're in for a deeper correction, and, maybe I should just get out right there. So that's all I'm saying is just have a plan in place for when some of your positions that you don't like as much or that aren't acting right, when they start to get a little wobbly, to have an exit strategy. And it's never a bad thing to take small profits along the way. So the Nasdaq is obviously, there's a lot going on down here from a volume perspective. A lot of distribution, but there's also a lot of accumulation to match right around that 50-day moving average. It just continues to happen. So the trend is your friend until it's not. There's really nothing to do. There is some rotation. We're going to talk about that, but I think you really have to stay with your positions as long as they are acting right to really get the most out of them, because, it's not about, making 5-10% here. It's about those big moves that you get, those big rallies you get, and trying to get as much out of them as possible, right? It's when you're right, you need to make the most money when you're right. And I think right now a lot of people are right. So let's look at the S&P 500. This is leading the Nasdaq. And there's nothing wrong with that. Sector rotation happens. Financials are starting to get a boost from interest rates. But we look back here and you can see that the S&P 500, it had a blow off top, but just pulled back, created just the smallest cup with handle, and then is taking off again. So the market is very, very strong. Could that come to an end very quickly? Absolutely. But you just don't know when. You talk about the 80s and 90s where the S&P 500 was averaging, double digits, mid double digits, 15% for a long time. So I think you want to continue to have a momentum-based strategy where you're continuing to find the strongest stuff and putting your money in there. However, in the short term, this upwards trend line, you can see every time the S&P 500 has touched it or even gone a little bit above it, it has pulled back a little bit. So maybe, after today's gap, everyone's getting excited. Maybe today, maybe we do see some weakness for a few days. That doesn't mean that the sky is falling. It just means that we're at a point where the last 1, 2, 3, 4, 5, 6 times when we touched this trend line, we did find a little bit of pullback. So if you're looking to put some money to work, maybe you let the market come to you a little bit. Just like the Nasdaq has found support at the 50-day moving average the last 5 times. The last 6 times the S&P 500 has found resistance at this upward trend line. And this is barely a blip on the screen in the long-term picture. So they're ugly. The gap downs are ugly, but they happen even in short-term 3 to 4% pullbacks. So just kind of keep that in mind and know where you're at. Know where you're at with the trend in the market. Don't get too complacent and just chase things. I always say, like, sometimes when we just get in these rally modes, towards the end of the rallies, you just start to get this euphoric feeling. I know I used to, where I'm just like, man, I just got to buy something. You just got this feeling where you just want to buy, you want to put more and more money to work. And typically when you get that feeling is sometimes the time where you need to let the market come to you. And I've got that feeling a couple times. So just kind of keep that in mind. I want to dive right into bonds and treasury yields because this is the TLT, the 20-year bond ETF. It has been in a bear market. It was at a 2-year downtrend line, and it touched 3 times, and there was a breakout, but it wasn't a definitive breakout. You can see that it did not cross this horizontal. Then interest rates started to move, and that pushed bond prices back down. So the bear market continues. Could this just continue to base for a while? I don't know, but I do know that, this could mean just continue further downside for bonds. And I always tell people, it's really interesting. I'm not telling anyone to go out there and sell their bonds, but bonds can underperform for significant periods of time. I understand the diversification argument, but bonds, just like dividend-paying stocks or more conservative stocks, they can go down, and they can be down for several years. So sometimes, to me, conservative is just making sure that you are in the strongest sector and not letting the weak ones drag you down. That's conservative to me. But most of the time, bonds are going to have a direct relationship with utilities. So if the bond prices are going down, interest rates are rising, that means utilities are probably going down with it, and vice versa. Because you can see these REITs and these utilities, these high dividend paying instruments are highly correlated with bond prices, and that means they're negatively correlated with bond yields. So with that being said, you can see right here, the purple line, this is the relative chart, the S&P 500 to the bond prices. So you can see that the market is clearly, this is outperforming bonds, stocks are. So again, to me, I want to be in the strongest one, but maybe you don't. I don't know. Let's look at let's look at a long-term chart of yields, and then let me shrink this. So this goes all the way back to 1974, and I just love sometimes looking at those longer-term pictures, just because you have to be willing to look at history in the long term just to know what's possible. And I think it just goes to show you that sometimes anything is possible. But it has been in a bear market for, since 1981, right? This downtrend line is, a 35-year downtrend line. So in 2011, the way I see it, and different technicians will tell you different things, this has been a, 7-year head and shoulders inverse pattern. So it broke out. Now we're going to zoom into this time frame, right? Because we are at a pivotal point in history, at least in my lifetime, because this bear market started slightly before I was born. So we're looking at a 45-year chart. So let's go back and look at the last 8 years, and let's just see. Yeah, that's going to mess things up. So let me kind of just clean this up a little bit. Just kind of get rid of this downtrend line, just so we can look at it. So you can see, it's kind of, let me see if I can, oh well, that's fine. So let's look at this right here. So this is the head and shoulders, the last 7 years blown up, right? And I think you can see that clear as day. So you have the interest rates that broke out, and kind of had a little shakeout and then pulled back. But they really have just been consolidating under this major level this calendar year, kind of going up and down, up and down. Now it's coming back, and in my opinion, this is the definitive breakout. I would really be surprised if interest rates pull right back under it. But I think this is where interest rates rally. And, what is positively correlated with interest rates in the stock market, and that's financials. So right now, we're looking at a piece of, in my opinion, history where the 35 plus year bear market, 35 to 40 year bear market, and yields are over, and we are getting, it could be another 6 months to just completely just break out of it, no question. And different people are going to see different things on the chart. But I think the ship is turning and it's not coming back. So now we're looking at the other way. So if we look down here, this is a correlation chart of the TNX, the 10-year Treasury yield, versus the XLF, the Spider Financials ETF. Yields are positively correlated with financials. You can see it in the upper end of the chart. Not every time, but most of the time. It's crystal clear to me that over a long period of time, when interest rates are up, most of the time, your financials are going to be up with it. So that's when you start looking at banks and brokers and insurance companies and things like that. Now on the inverse, we got utilities. Utilities are inversely negatively correlated with yields. So when the yields really are starting to break out, utilities typically underperform. So they've been negatively correlated for, very consistently since 2013. That's a significant period of time. So we're just at this point. I don't want to say the changes. Let me kind of refresh this and kind of go back to the 45-year chart. So, if you're a nerd and you like to study the market like me and just kind of look at these interesting points in history, we're there. We are, in my opinion, there, and it might take some time to break through it. Now, there's no guarantee in the market. There's no guarantee these interest rates won't roll over, but you just have to look at the evidence, and the evidence is telling me that we are definitively breaking through this 3% level right here, and financials are worth a look in a long-term portfolio. So we got the bonds, treasury yields. Let's go look at the dollar, because that's another mover that is piquing a lot of interest. So you have the USD, the weekly chart right down here. You got another inverse head and shoulder. And this is like you had a definitive breakout right here. Bear market's over. And now it's pulling back under the pivot. It didn't just poke its head above and pull back. It really surged ahead, in my opinion, and is now pulling back under the pivot. So now we got to look at okay, the dollar is weakening. How far is the dollar going to weaken? I don't know, right? But let's look at the relationships that would go along with this. So typically when the dollar is strong, U.S. markets outperform emerging markets and international markets. When the dollar is weakening, you have the inverse. You have, emerging markets and international stocks start to lead. And if we look at relative charts right here, you got the S&P 500 relative chart versus the VEU, and that's the all-world international ETF, minus the U.S. So you have right here, if I could draw a line, let me actually do that. Let's draw a vertical line. So you have right here when the international stocks, and this is, just starting at the beginning of the month. So we're talking 3 weeks, so not anything to get all huffy about. But I like to look at potential early turning points, and this could be it. So we're looking at the international stocks are starting to outperform because the line is going down. So when this line goes up, it means the U.S. is outperforming international stocks. When the line goes down, it means the U.S. is underperforming. Same thing with international markets, right? And this could just be corrective action. This is not a trend change, in my opinion. But the interesting thing is small caps typically outperform the S&P 500 when the dollar is rising. And this peaked way back here. Small caps have been underperforming. Let me kind of just move this tracker right down here since July. So it's interesting to see these relationships when I start to see international markets outperforming and the dollar weakening simultaneously, and the small caps have already been underperforming. You just start to say, now where is the opportunity in here? To me, if you're looking at a longer term hold or even potential shorter term hold, I think the opportunity is international and in emerging markets. And I think that even if the S&P 500 and the U.S. markets do pull back, since the EEM, the emerging markets ETF, and others long ETFs are so down, I think they can completely buck a trend if the market starts to pull back, just because they've been in a bear market for a long time. So there's been this major divergence, and I was watching CNBC or had it on in the background, and they talked, the international stocks have been down so much, or in a bear market where the U.S. stocks are roaring. There's been a major divergences. Typically, all markets are going to move, somewhat in tandem. So the question is, do U.S. stocks come down to match their, counter international stocks, or vice versa? Do international stocks come up to match the U.S. markets, and eventually they meet in the middle? To me, it's kind of looking like maybe eventually they'll meet in the middle, but it's definitely looking emerging markets are kind of coming off the bottom. And let's just go look at some of those international stocks, ETFs. So let's look at VEU. Let's just look at the ETF. So you can see right here, it broke this green and red line, and I have the dollar crossed over in the background. But, it broke the downtrend, a 2.5-year trend line back in May, clear as day. That's the bear market started, and it's just been grinding lower. If I were to blow this up, it is trying to break out of a 6-month downtrend. And if you look at least this ETF, you can see that, they take these legs down, and as momentum slows to the downside, the undercutting of this low gets smaller. And then the undercutting of this low was not even a whole percent, like barely undercut it, and it's coming back, and it's trying to break out while the dollar is weakening. So, it's just all worth paying attention to, and just to see if the relationship could switch. But I think that just 1 month is not a trend change. I think you got to look at a multi-month and continue to take it. You got to take it day by day, or at least week by week, when you're looking at these longer-term pictures, because it can change very quickly. So that's looking to break out, or is very close. I just don't know. Okay, if we look at the emerging markets ETF on the candlestick chart, bear market, death cross. You got the 50-day moving average is under the 200-day moving average, so you got the death cross right there. Again, you get the legs down, and then as the undercut gets small, like this undercut this right here by 7-8%. And then the next undercut was, maybe by 2-3%. And then this undercut was maybe by 1 or 2%. So while we're looking at that, if I go down here to an oversold RSI 10, you can see that this leg right here, it dipped into oversold territory, came back. However, when the price made a lower low, the RSI did not. So it's showing me selling is exhausting to the downside. For a potential nice move, I don't know if it's a trend change, but I mean, to me, it's worth the risk, put a stop under here to see if you can get a little oomph in emerging markets. So it's just, that is a positive divergence right there, in my opinion, on the emerging markets charts. Now, there's a lot of other evidence that we're going to look at here in a bit, with commodities are starting to pop in the last week, and commodities and emerging markets are highly correlated, as well as commodities and the dollar are highly negatively correlated. So they all work together, or in opposite of each other. But this looks interesting to me, even though the chart still looks ugly as sin. It still looks interesting. So, we talk about rotation. The S&P 500 is taking leadership, and you got that rotation in place. Let's just to show you, let's look at the breadth on the 20-day EMA. And I typically don't look at breadth charts that are that short term, because I'm looking for a bigger picture when I look at breadth. But you can see right here what percent of each index, or excuse me, which sector is going in the right direction. So you have the S&P 500, 61% of stocks are above their 20-day moving average. And it's so interesting to watch this sector rotation. So you have the XLK, the technology. You can see that breadth is weakening, which makes sense because we just saw the Nasdaq underperforming. XLF, breadth is strengthening. Money is flowing in, which also makes sense because interest rates are rising. XLY, that's discretionary, headed higher. XLI industrial, which is in a bullish, way above 70%. XLV is just kind of him-hawing around 70%, but that's also still very, very bullish. XLP is moving down a little bit, and that is your consumer staples. This is your healthcare, this is your industrial, this is your consumer staples. Your recession-proof stocks, your cereals, your cigarettes, whatever it is that you're going to buy, whether where you have a recession or not. Also high dividend paying stocks. So a couple reasons why the breadth could be weakening in this. One, interest rates are higher, which is pushing the appetite into further away from the dividend payers. Or money could just be rotating out of staples and moving into more aggressive areas. Energy is starting to surge up from the bottom. XLE, you can see it's moving up. Material, same thing. So you have two commodities that are starting to go in that direction. And then look at the XLU, utilities. So it's interesting. Commodity breadth is strengthening, and utilities are just weakening. So this is just really just a quick snapshot of what everything looks like from a breadth standpoint. Now, if you go to the overall market breadth, the big picture, I mean, there's nothing to see. 76%, 77% of stocks in the S&P 500 are above the 200-day moving average. How can you make a bearish case for that? I don't think you can. You could say the market needs to pull back, it's extended, yada yada yada, but look at what happened in 2017. And then you had to go, it's just not breaking out of a consolidation. So if this were a stock, you would say, yeah, it's made this nice move and maybe it needs to pull back, but also it's just now breaking out a few weeks ago, last month. So plenty to like. Again, I think the market could ease a little bit, so I'm trying not to get too euphoric. So we did just look at the breadth. Let's go look at the sector summary. So staples and technology are leading today. They're kind of, one's defensive, one's aggressive. I don't really care about a 1 day. I like to look at the 1 week and the 1 month. Boom. Financials, matching interest rates, materials and energy. You have your commodities, which are also inversely correlated to the weakening dollar. So these relationships, why these are up, that makes sense. Utilities are down. That makes sense. Now, 1 week isn't a trend. Let's just look at a month. Cyclicals, you have your aggressive, right? All aggressive stocks towards the top, and then you have in the last 30 days, you have your weaker sectors or your more defensive sectors right at the bottom. That's exactly what you want to see if you're incredibly long a bull market, right? Or at least in the short term. So again, you can always make the case for why the market should pull back, but bulls make money. It pays to be bullish. And if you're always making the case to be a bear, you're going to miss out. I guarantee you. I used to have this problem years ago. Every time the market pulled back 3%, thought, the sky was going to fall, and I thought it was going to be another bear market, and it just didn't happen. So I missed a lot of opportunities waiting for a deeper pullback or a deeper correction that never happened. And part of that was I got into the industry right at 2007, so I think it conditioned me a little bit. When in 2008, every day the market's down 6%, up 6%, it was a volatile time, and I was in a financial advisor's office, so it probably conditioned me a little bit because I came in seeing some messed up stuff. Hopefully I won't see that again for a very, very long time, but I have so much more knowledge now, especially from a technical chart. I'm going to be out long before that. Okay, let's keep going. I want to look at the VIX real quick, and I don't make trading decisions off the VIX, and that's the fear gauge, the volatility index. So when the number starts to get above 18 and spikes above 20, you have a lot of fear, a lot of people buying puts, shorting the market type of thing, or at least buying portfolio insurance. I mean, it was kind of climbing, looked like it was going to keep climbing, and then all of a sudden we've had a really good 2 weeks, and it's making lower lows. So there's not a lot of fear as the market's breaking out to an all-time high. It's just hard to make the bearish case. It's easy to make the bullish case for the VIX. Let's just go look, to sum it up, a couple of industry groups. So I just track 25 industries, and I just come in here, and what I do every day is like, okay, so what's the strongest, what's the weakest, and I just kind of flip them. So you have home construction, aerospace. I mean, they're not down a ton, so it's not like they're getting slammed. But the strongest, copper miners. So you've heard me talk about stocks and personality changes. When all of a sudden something changes personality, something does something different. Technically speaking, you need to pay attention. So copper miners are now above the 50-day moving average for the first time in 4 months. Okay, that's a different technical picture. Does that mean you buy this breakout? No, maybe it pulls back a little bit. Maybe that's an entry. But again, now it's time to be laser focused because the personality of this ETF is changing. I bet we could find the same thing in steel. Something very similar is 2 days now above the 50-day moving average. These are broken charts. These are in downtrends. Don't get me wrong, but you know they could just be taking a break, taking a breather. So you have steel and you have copper really being strong today. You have semiconductors, which has really been a zigzag higher, but I mean it's still quite a bit higher than its January peak and has been grinding its way higher. So up 1.5%. There's a bullish case for that. Biotech, been pulling back for a couple weeks, I've noticed, but again, it's strong today, so got a risk on type of environment. And you have financials. So this is just another financial ETF. Financials have, I'm going to draw it right here. Financials have considerably lagged. They are not even close, well, you know, 4 or 5% from breaking the January high. That's how you know it's a lagger. But it broke out, you know, back in July, came back, and it retested the pivot a couple times, retested this breakout zone, and is now trying to move higher, a little volume stepping in. It's still got a lot of work to do, but if interest rates continue to perk up, these could play catch up, and they could play catch up very, very quickly. Let's look at gold miners. So, okay, you got gold miners right here, and I'm just sticking for making the commodity case. I'm not just telling you to go out and buy commodities. I'm just saying their personality is changing. They've been in an ugly downtrend, and now they're breaking. So, you know, now it's closed 2 days above the 20-day moving average. Hasn't been done that since about 3 months ago. Okay, so it's doing something it hasn't done in 3 months. Getting interesting. And then you have a lot of other ones, and I kind of want to close this off. I think you have to address the weed ETF. The weed stocks are just absolutely parabolic. This is an industry that, geez, I think I bought here and sold here, and I just cannot find a decent entry to get back in because I'm not going to chase something parabolic. It's never really worked out. But it's hard not to look at that and just say, dang. But, you know, that's just part of it. You got to do what's comfortable. But you have a weekly reversal pattern right here, you know, that I've talked about. You got this bottoming pattern right here at the low, and, you know, undercut the previous week, closed above the previous week, and above average volume. So you play that weekly reversal, which we did. Took a 10% profit and just took it way early. But that's part of it. You know, some just continue to go to the moon, and some would roll over. But, you know, I think there's a lot of euphoria right now in the marijuana stocks because everyone's saying that they're going to continue to go up, or that, you know, all these beverage companies are going to start owning shares so they can kind of hedge their bet. So there's a phenomenal case for them. They are not really anywhere near a potential support or a buying opportunity that fits my personality. If we want to go back to the emerging markets case, QUEB, the Chinese Internet ETF, also very similarly correlated to emerging markets, also completed a weekly reversal pattern last week. So, that coupled with emerging markets, it continues to look interesting. With the Babas of the world, those weekly reversal patterns. So it's really interesting sometimes when some of these stocks or some of these industries, they get in downtrends and then they all of a sudden reverse at the same time. One reversal in the whole industry, you have less evidence to support your theory that the bottom was just put in. When they all start to reverse, then you're like, okay, this is going to give me more confidence to place a trade, place a stop under the last week's close right here, and just see if it can make a run. So I hope this was helpful. Let me know if you have any questions.